How do tax brackets compare internationally? Tax brackets are an important part of how countries manage income tax. They determine how much tax individuals pay based on their income levels. Around the world, tax brackets can look very different. This variation reflects each country's economic policies and social goals. In many capitalist nations, tax brackets aim to balance the need for government revenue with the desire to encourage economic growth. Most of these countries use a progressive tax system. This means that as a person's income increases, they pay a higher percentage in taxes. However, the specifics can vary widely from one country to another. For instance, in the United States, the federal income tax brackets for the year 2025 range from 10% to 37%. The highest rate applies to taxable incomes over approximately $626,350 for single filers. This system uses multiple brackets to gradually increase the tax burden as income rises. The goal is to maintain incentives for productivity while also funding essential public services. Looking at Europe, many countries have higher top marginal tax rates. For example, Portugal has a top rate of 48%, plus additional surtaxes for very high earners. Poland imposes a 32% rate along with a solidarity tax for those with very high incomes. Greece has a top marginal rate around 44%. These higher rates often reflected a stronger focus on redistributing wealth within capitalist frameworks that combine market economies with social welfare policies. Some nations take a different approach with simpler or flatter tax systems. Romania, for instance, has a flat personal income tax rate of 10%. This aligns with a market-oriented strategy that aims to reduce complexity and encourage investment. Interestingly, some countries do not have a personal income tax at all. Nations like Saudi Arabia and Qatar relying on revenues from natural resources instead. This system allows for capital accumulation by minimizing individual tax burdens, but it heavily depends on state-controlled revenues. From a capitalism perspective, tax brackets around the world show a wide range of approaches. Lower tax rates and simpler structures can stimulate entrepreneurship and investment. On the other hand, higher tax brackets in certain countries aim to tackle income inequality and fund public goods. This balancing act is essential for maintaining social stability while promoting economic growth. In summary, tax brackets vary greatly from low flat rates to high progressive rates. These differences reflected how countries balance wealth creation with income distribution. The United States falls in the middle with progressive brackets topping at 37%. Meanwhile, some European countries impose higher rates, while others adopt flat or no income taxes to encourage economic dynamism.